I'm from the ESRI here in Dublin, and it's a great pleasure to be able to chair this session. So we have 3 papers. So the first paper is entitled Rising Temperatures, Falling Ratings, the Effect of Climate Change on Sovereign Creditworthiness. And it will be presented by Matthew Agarwala. So the presentation should last around 20 minutes, and then we will have 15 minutes of a discussion, and then it'll be opened up to the floor for the remaining 15 minutes. So Matthew.
Can you hear me?
Yes.
Perfect. So thank you very much. I'm an economist at the Bennett Institute for Public Policy at the University of Cambridge, and I'm delighted for the opportunity to come and speak to you today about our latest working paper, Rising Temperatures, Falling Ratings. Our core interest in this paper is to try to understand how future sovereign creditworthiness might be affected by climate change. And in order to try and answer that question, I'm going to take you through a model that we've created and show you some results that I think are fairly compelling. There's a bit of a process though, because this is an odd kind of question, and the research literature hasn't really addressed things like it or quite like it in the past. And so what we're going to need to do is allow me a bit of imagination, and we're going to do some climate time travel. So we're going to fast forward through time into the future, keeping everything the same. So this is ceteris paribus conditions, except we're going to let climate change, and we're going to let that change in climate have an impact on some key macroeconomic indicators. And in that model, in that scenario, we're then going to start asking questions like, how different would a sovereign rating be? Questions like, how might climate policy affect the impact of climate on ratings? And finally, we need to put some numbers to this. So what might be the impact on the cost of servicing our sovereign debt? And in order to do this, we wanted to set some ground rules for ourselves. And so we wanted to follow this simple overarching principle throughout. First, we wanted to remain as true and as close as possible to the core climate science models that we have available to us. Next, we wanted to ensure that we used the best and latest, most powerful climate econometric models that we could find. And crucially, we wanted to remain as close as possible to the real world calculation of sovereign credit ratings. We're not playing around in some ESG alphabet soup, coming up with our own indicator that we think other people should start caring about. We already have risk metrics for sovereigns. And so we thought we should adjust those for climate change, because markets already know what those sovereign ratings mean. They're hardwired, they're in the DNA of the financial system. And so we thought if we could make an intervention there, then it could be that much more useful in the real world. Now, there's a large literature of people trying to predict or create or assess the impact of any indicator X on sovereign ratings or on the sovereign bond spread. But the vast majority of the work that's out there takes a backwards look. Essentially, it's regression models trying to identify the partial effect of something like climate vulnerability or temperature change on historical ratings in the past. And that's all well and good, but it doesn't answer the question that I'm really interested in. It can only ever give me a backwards look. And I would submit to you that a risk metric that can only tell me that something was risky after the fact, that there's a problem after it arises, is of limited to no use, really. Instead, what we really want for the financial system, if we're interested in greening the financial system, is to have risk metrics that can look forward and tell me about the future effect of climate change on future financial assets, like sovereign bonds. It's a pretty important difference. It's essentially what I'm talking about here is the difference between getting a diagnosis from a doctor beforehand or getting it from the autopsy afterwards. Right? If we can't start, if those of us who are working in climate risk can't start behaving more like doctors and less like undertakers, then I'm not sure what good we're doing in the world. And so that's what we set out to try and do. We wanted to bridge the gap between the incredible climate science that we have, which is improving every single week, and the real world of sovereign credit ratings, because they make a real impact in the financial system. Sovereign ratings are the largest asset class in the market. And so these things really matter to us. And in order to do this, what we needed was a model to predict a sovereign credit rating. And so we created one of those. But we wanted it to be subject to a few different criteria. First, the data included in the model, the variables included in the model, need to be relevant. That is, they need to be the same as the variables that are included in the real world sovereign credit rating as calculated by S&P today. That brings us to that overarching principle of real world relevance. We also wanted it to be variables that are important to climate science and climate economics. And so we wanted to include variables where we have decent information, very good information actually, on how climate change will affect them. And the final criterion was that we're not going to sell our souls. We have some expectations of the quality of the economics and the rigor of the statistical analysis. And what you will find if you look into the ratings prediction literature is there's an awful lot of fairly shady econometrics, where people sort of skirt the rules of dealing with collinearity and non-linearities in the regressors. And it's just not good practice. And so we didn't want to do that. We're not going to make a Faustian bargain to ramp up predictive capacity if it comes at the cost of our econometric integrity. And so, if we can do this, then I think I can give you a climate-adjusted rating. And when we have a climate-adjusted rating, we know from the finance literature that a change in a sovereign rating has a knock-on effect on the cost of servicing debt. So I'm going to do a very simple description of the model. In fact, I'm barely even going to describe it at all because that's in the paper and you can look at it. It's a pretty run-of-the-mill machine learning random forest model, which kind of allocates countries into bins based on a few different nodes. And the different nodes are each variables that we've included in the model. And so what's in it? Well, there's 6 variables. There's GDP and the GDP growth rate. And then there's some government performance indicators, the ones in blue here. The net general government debt to GDP, the current account balance to GDP, general government balances to GDP, etc. These variables we know from the ratings models are really important in assessing sovereign creditworthiness. And then we wanted to know how can we adjust these variables for climate change? Well, a macroeconomic climate model, like the one created by Kahn et al., tells us directly how GDP and GDP growth rates might be expected to change under various warming scenarios for each country out to 2100. And so we have both the raw variable as is and projections of that, and we have the projections of how it might change with climate. But there's nothing in the research literature. There's nothing in our journals that tells me how climate change is going to affect narrow net external debt to current account receipts. It's just not one of those variables of interest that's made it into the literature yet. And so we're back to this problem of how do we adjust these things to reflect the impacts of climate change whilst maintaining our allegiance to the science, the economics, and the way that ratings agencies actually think about these things in practice. And so to do this, we went to S&P and spoke to them and took a look at the research that they've done in the past from their sovereign ratings team to think about how they might adjust these. And so our adjustment for climate change includes 3 things: a little bit of S&P's own thinking, a little bit from the Kahn et al. Macroeconometric model, and a little bit of creativity, and I'm going to try and explain it, and hope you will accept it. But before we go into that, let me just show you how well, actually no, we'll do it, I'm going to do this out of order then. In order to adjust those government performance indicators, the variables in blue, for climate change, we needed to do something a bit different. S&P actually had some research that they had done in order to try and figure out the effect of natural disasters on the performance indicators, things like the debt to GDP ratio, the current account balances, etc. And so we used their research that they have well before we started our project. And what they showed us, I hope you can see the arrow, the pointer on my screen here. On the horizontal axis, we have the GDP loss that a hypothetical natural disaster might deliver to a country, right? And so it starts at 0, and the bigger the loss, the further to the left we go. And then we have, for each of the performance indicators, so this one is the net general government debt, S&P's estimation from their analysts, from their sovereign ratings team, of how much this particular GDP loss driven by a natural disaster might affect the indicator that we have on the left axis, on the vertical axis. And so each dot here represents a country with a hypothetical natural disaster, the impact that it has on the country's GDP, and what S&P thinks that would do to the net general government debt. And so once we plotted all of these, we just tried to find a best fit line. We started with a straight line. It didn't fit the data very well. And so we just fit polynomials of increasing order until we could find no additional goodness of fit. And once we have that, we've got a function to describe, to translate a percentage loss in GDP into a change in our government performance indicator. With that, we combined the climate adjusted GDP and per capita GDP that we get from Kahn et al. And we take a look at the ratings model. And so what you see, what I'm trying to do here is test how good is our model at predicting the sovereign rating. Okay? And I'm doing this before we've calculated, before we've incorporated climate change. So before we think about climate change, I just need to convince you that the ratings prediction model we have is sound. And what I'm showing you here is the absolute value of the difference on a 20-notch scale between our predicted rating and the actual observed rating from S&P between 2015 and 2020. And what you can see here is that, you know, the darker green is the best fit, a perfect match. As we go lighter into the yellows, our predictions are worse. You can see we're pretty good at predicting the Northern Hemisphere, pretty good at predicting most of the Southern Hemisphere. We're pretty good across hot countries and cold countries, pretty good across rich countries and poor countries. We're not very good at Argentina. We're not very good at Iraq. And we're not very good at producing maps because we've inflated the size of Russia and Canada and Greenland and then constrained the size of Europe. And I apologize for that. But once we have all of this together, we can then investigate some different climate change scenarios for 108 sovereigns for which we have the data. And so that's what we did. And we looked at 3 different warming scenarios. RCP 2.6, which is basically consistent with limiting warming to below 2 degrees. RCP 8.5, which most closely tracks the past 15 years of emissions data, but if we were to continue on that trajectory, would leave us in a world of 4.5 to 5 degrees warming. And then we also in the paper take a look at, well, what would it look like if we allowed the volatility of temperature to rise as the average temperature rises? So basically, as the world gets warmer, the weather gets weirder. And now we can take a look at the actual results. So What I'm showing you here is on the left-hand side, RCP 2.6, essentially 2 degrees, and on the right, RCP 8.5, essentially 4.5 degrees. The thick black line would indicate that there's no change in the ratings. And each dot on the map, or each dot on the graph, is a country. And what we see under RCP 2.6 on the left here is that even if we meet the Paris Climate Agreement, by 2100, there's a whole bunch of sovereigns, at the top rated sovereigns, who are going to face at least a notch or two downgrade. So that kind of warming is already in the pipeline. But if we look at RCP 8.5, the downgrades, I'm showing now just the best fit lines, from 2030 to 2050, 2070, and 2100 are much greater. And so what we see is that even inside the decade, by 2030, we see sovereigns facing downgrades. And this is a zoom in on RCP 8.5, and we see that 63 countries would face a sovereign downgrade with an average of about 1 notch, although for China, it's a drop of 2.5 notches. And of course, if you'll forgive the odd projection on the map, we can look at this on a map as well. And what we see is that no country, no class of countries escapes. Rich countries suffer downgrades. Middle-income countries suffer downgrades. Poor countries suffer downgrades. Northern, southern, hot, and cold countries suffer downgrades. The only ones that are odd are Argentina and Iraq and Colombia, maybe. A couple of these are odd, but that's because these countries have had recent defaults, recent wars, political instability, and none of those variables are included in our model. They're not included in our model because we don't know how to adjust them for climate change. And so I wouldn't overinterpret the upgrades that we're showing here. Most other papers would just drop them from the analysis altogether. I promised you a quick look at what would happen if temperature volatility rose as the average rises. So it gets warmer, weather gets weirder, higher highs and lower lows. And we can see there on the right-hand side here that the downgrades are across the board and very severe. Remember, the 10 point on the rating scale here is the cutoff between investment versus speculative grade. And that really matters. So let's take a look then at what this means for the cost of sovereign debt. The research literature tells us, you have a downgrade, a sovereign downgrade, it increases the bond spread, it increases the cost of the annual debt service. And so we calculated this just taking the coefficients from the research literature, and we did it for the G7 and the full sample of countries under both RCP 2.6 and RCP 8.5. And what we see is that globally, if we meet the Paris Climate Agreement, then the climate-driven increase in the annual interest payment on debt on today's level of debt is only 20 to 30 billion. But that under a higher emission scenario, it's much, much higher, 137 to 205 billion. So what's the scale here? Well, for the US, the
2 minutes
annual interest payment would rise by about 25% on its sovereign debt. So the final thoughts here are that we can do climate finance risk assessments that build on the science. We don't have to run into this ESG alphabet soup of very little science and very little evidence, right? At least with the sovereign rating, we know what the question is that we're trying to answer. What's the change in the likelihood of default? With ESG, we don't know what the question is. It doesn't stop people from trying to answer it. What else does it tell us? It tells us that it's going to be cheaper to invest now, to borrow now, to invest in order to avoid climate change, to invest in mitigation and in adaptation, because our entire public debt will become more expensive if we don't. And of course, the Paris Climate Agreement is something that we should really try to meet. And that's my time. So thank you very much.
Thank you. Thanks very much, Matthew, as well, for keeping very much to the time. Okay, so our second paper is sustainable finance with green bonds for a low carbon economy. It's a joint presentation, and to start us off, we have Shua Braga.
Thank you. Good afternoon, you all. Let me share my screen. Okay, so good afternoon. So that's our presentation. We present today. Andreas and I will present a joint paper with Willis Sander as well, in which we discuss the role of financial market and in the climate transition, focus on green bonds. So a little bit of introduction and motivation of our paper. So we know that green bonds have expanded recently, sharply, and carbon taxation as well as instruments to mitigate climate change. And it depends a lot on the participation of the financial market and on the attractiveness of these bonds for private investors. And in that sense, we have two scenarios, like one scenario in which financial market is a roadblock for green investment, which is the current one, in which investors are short-term oriented, which constrains investments, which can rise financial stability in the future. And another scenario in which financial market can help climate transition. So in this paper, we discuss the benefits for investors' portfolio of a climate-oriented approach. We basically have two parts. In the first part, we present a dynamic portfolio model to study the environmental and social welfare benefits of investing green in the perspective of a investor in the financial market. Okay, so these are the long-term benefits and effects of investing in green bonds. And then in the second part, we empirically studied the benefits of green bonds, the actually financial benefits of green bonds in the present, with a reward to risk analysis comparing green bonds with conventional bonds. What's behind our paper is the idea that public policy can right now help attracting investors to green bonds in order to avoid future financial and climate risks in the financial markets. First, some of our conclusions before showing the methodology and the empirical analysis. Our dynamic portfolio model shows that green investment actually brings positive externalities that might increase wealth accumulation in the long run, but actually depends on the investors internalize the externality effects and benefits of investing green, and also depends on the fact that green innovation is undertaken. In our empirical studies, show that green bonds currently have higher risk performance, basically because of lower volatility, but there is still heterogeneity between currencies and sectors, as well as lower yields, which might imply that green bonds are less attractive to investors in the present. So that's why public policy can intervene. So now back to the model and to our analysis, so we can discuss again these conclusions. We have first this dynamic portfolio model for green investment. Okay, I'll not discuss the details of the model, but we basically have investors that go to the financial market and they can choose between two different risk assets, a green or a fossil fuel bond. So investors are choosing between like investing in green energy or in old energy technologies. And they maximize the utility by doing that. At the same time, investors can channel the return earnings in financial markets to consumption or to investing more in financial assets that are channeled to green innovation. So it's not actually a conventional KPI model. It's a dynamic portfolio model based on Merton's approach to portfolios, but we add the idea of innovations and green innovations and knowledge and externalities to the model. Okay. So we first estimate the returns of the green bonds and the fossil fuel bonds based on, as Matt just said, like backwards data, and we adjust this backwards returns from both green and fossil fuel returns with externality effects. So we can have a forward looking to these returns, because you know that in the end, fossil fuel assets will likely become stranded assets, and green bonds might have higher earnings. So these are our estimations for green and fossil fuel bond returns. We use harmonic oscillations estimation, so we have actually oscillations in our returns, and this is our results. We can discuss it later in detail, but basically, when I have a higher externality here in the top, the dynamics of wealth of the asset values perform better than the other situations. What happens here in the model is that at some point, as the fossil fuel assets become stranded assets, the asset values decrease, but the investors can recover when the externality effects due to green innovation take place. So that's our result, and we see that basically investors when they price the externality effects and benefits of green bonds, they basically fully divest fossil fuel bonds and invest in green bonds. If they don't completely price it, investors diversify and get worse outcomes. So we have then two questions. One is responded by Andreas in the next part, in the empirical part, that is whether the green bonds are attracted right now and investors already priced these green externalities. And the other question is if it's also the case of using green convertible bonds, as our model shows that bond returns will might sharply increase in the long run if these bonds could be converted to equity. These returns could increase even more. So I'll leave the floor to Andreas so he can show a little bit the empirical results.
I would share my own screen if you stop sharing, Joao. All right. Thank you for the first half. I think everyone can see my screen, right? Okay. So I'm going through now the empirical part of our investigation of the comparative analysis of green versus conventional bonds. And I have a lot of slides and tables, so don't worry, we will not go over them in detail. I just want to have them like here in case for the discussion we want to go back to them. So I will just like jump through and summarize the results. But first to structure a bit the hypothesis that we had in mind based on what Joao said with the externality argument. So for green bonds forward looking, we would actually expect positive long run externalities with higher returns and conventional bonds lower returns. So with regard to financial accumulation, the question is, when there are negative externalities, do they feed into the uncertainties of the financial market and have a negative impact on investment? And therefore, in how far is volatility impacting the accumulation of wealth through financial assets? And in how far does the green versus the conventional or the fossil fuel case lead to a better and a more continuous wealth accumulation. Empirically, we analyze the key variables of the Sharpe ratio, which is the reward to risk ratio as the measure for wealth accumulation. And we also test primary and secondary yields, where a lot of papers actually in recent literature. And we also include different volatility measures over 30-day, 90-day, and 260-day window, the bond prices for green and conventional bonds. And here on the top, you can see that the definition of the Sharpe ratio is basically the excess yield, so the portfolio yields minus the risk-free rate divided over the portfolio standard deviation, which is like a single measure for a set of assets. And what we're going to use is a creation that we call the bond-specific Sharpe ratio. So we're going to put the volatility for an individual asset here in the denominator, and here we just use the yield to maturity rate as the bond-specific return to then estimate in how far does a financial asset perform in terms of its risk to return ratio. The empirical literature finds mostly does analysis, as I said, in terms of bond indices and yields. So they've actually found negative green premium based on bond indices. Also the negative, there seems to be negative yield in the primary market. And on the other side, in the secondary market, yields seem to be different. There are specific cases where we do find negative yields, as for institutional and certified green issuers, with the argument that there are pro-environmental attitude of investments and also better reputation for higher ESG credibility. So that's when there is excess demand in the yield at issue in the primary market, but it's not the same as in the secondary market. And something that we look into is the structure of financial assets and their impact by environmental factors. So do fossil fuel bonds evoke negative environmental externalities, and how far are these impacted by, or how far are these reflecting the volatilities of the bond, and therefore included in the wealth accumulation of assets. So I said most papers that analyze primary and secondary market yields, and maybe there's a paper of Loeffler et al., which also looks into one volatility measure, but often sectors are not included and none actually, or very few, use the Sharpe ratio. Our studies, we include key variables, the primary and the secondary market yields. We have 3 different bond volatility measures, and we use the Sharpe ratio as a central key variable for the wealth accumulation. And also we look into different sectors for private issuers. We have the sectors where most green bonds have been issued so far: finance sector, utility sector, energy sector, and also the government for the public one. There are a few papers who use the Sharpe ratio, but not a lot. So Ehler and Pecker in 2017, they did a cross-sectional analysis and had 21 green bonds between 2014 and 17. And they used bonds that were similar to conventional bonds, but they did not use a bond pairing algorithm because they only selected them based on their indices, and they also did not control for rating. In our case, we do have more than 1,500 green bonds issued between 2017 and 2020. We use a bond pairing algorithm that is similar to bond pairing algorithms in the literature that also controls for rating. We also further add a non-parametric analysis for the bond volatility, and also we look into different sector-specific effects. And additionally, just to summarize the results, Ehlers and Pecker, they do find that Sharpe ratios are slightly higher for green bonds, but not significant though. And in a more recent paper from Han et al., we use a covariation value at risk model. They find that Sharpe ratios for green bonds do improve stock bond portfolios in different market environments. So there are like 4 different sections that I actually would like to go through in terms of the results. We did a basic multivariate regression model across the whole sample. Then we used this bond pairing algorithm. So we matched green with conventional bonds to then analyze again the impacts of the green versus conventional bond results. the card, the classification and regression tree analysis is a non-parametric analysis to look again into the performance of the volatility of in our sample. And then we also look into energy specific effects, because we were not able to pair bonds based in the energy sector because there were no issuers that issued a green and a conventional bond that could be compared. So we had to sort of use for the energy sector, do it separately. So for our multivariate regression model, I'm not going through this in detail. We have here like the set of explanatory variables with very known candidates like the rating, the maturity structure, coupon rate, and so on and so forth. Our key variables, again, we use the yield at issue, which we abbreviate with YAI, the yield to maturity, which is the secondary market yield that we use, YTM, and here our bond-specific Sharpe ratio, which is basically the yield to maturity rate divided in the numerator and the volatility value in the denominator. And for our base model, we would just include the 9 explanatory variables. For the second model, we would also add the sectors that we have here: finance, energy, utilities, and government. And then we have currency-specific models where we just add another index here for either euro or US dollar. And what we do find is that in our first regression, we're actually in line with the literature, where we do also find a negative green premium. So you can see here a negative value for the dummy, and also a negative effect for the yield to maturity rate in our base model, the one that controls for the sectors, and also the one for the different currencies. However, there's some certain heterogeneities between the currencies, which you will also further see in the other slides. And for the bond-specific Sharpe ratio, we see that we have a positive effect for greenness here. I'm not going through the details of our pairing regression. I can look into this later, but we have basically a set of 1,000 paired observations that we can compare based on the same issuer, currency, maturity, and S&P rating. And we take the difference of the green minus the conventional bond variables, where we had different ones, also adding again the same rating as a control factor. And I just want to look into the Sharpe ratio pairing result, because here we see again that Sharpe ratios for green bonds are positive and significant, not though for the euro currency, but if we don't control for currencies and in the US case. And also what we can see in the volatility here is that we do see that volatilities are sector specific, and actually for the government sector as well as for the energy sector, we do see that for the different volatility values, the 30, 90, and 260 day, we do see the further we go into the past, like the longer we look for the volatility frame, the more negative is the impact of the conventional bond to being higher in terms of volatility than the green bond. So there seems to be a clear effect that and conventional bonds do show higher volatilities, which is something that we further analyze with the non-parametric analysis of the classification and regression tree. So the variables that we used for the splitting was the bond type, is it green or conventional, the different sectors, the maturities and ratings. Yes, yeah, I'm about to finish. So this is the big tree, which I split up in the left and the right branch. So basically the take-home message here, we just look at the left branch now, is that the most significant factor for splitting is the sectors. So we see energy sector is a very significant way of gaining the biggest differences between volatilities. And for all cases, we do see that conventional bonds have higher volatilities, which means they're to the left of the green bond, which is here, conventional to the left of green, and here. And also for the right branch of the tree, we see conventional is always left of the green, which means higher volatilities. For the energy sector analysis, I just also want to show you the Sharpe ratio results, which is basically not that strong, but we do see for the Sharpe ratios that were calculated for different volatilities, a positive and significant effect in the Sharpe ratio. Again, there's some heterogeneity across currencies. And so basically the discussion of the results that I can summarize is there is consistency with our hypothesis. Sharpe ratios are higher for green bonds in unpaired and in the paired cases. Volatilities do seem higher for conventional bonds, especially in the energy sector. Also consistent with the literature is that there's a negative risk premium in the multivariate regression case of the primary bond market yields. However, inconsistencies are that, I didn't show that in detail, but the yield at issue and the yield to maturity rates, they show different results with regard to greenness. And also there seems to be a strong heterogeneity across currencies. So for the euro case, we always see slightly different results. Further limitations are we don't have a longitudinal sample, but this is only cross-sectional one from October of last year. And there have also been many non-availables for certain yielded issue values and a very unbalanced sample. So just as the final concluding slide, our dynamic portfolio model basically tells us that green investment is associated with positive externalities that can prevent long-term climate finance risks and ensure better wealth accumulation. Policy and externalities effects do increase green bond returns and attract investors. So resources, here's advice for policymakers, should be channeled to long-term oriented green investment, and also green convertible bonds should be considered. In line with our empirical analysis, we see that investment opportunities for green bonds do show mostly higher Sharpe ratios and lower volatilities. Results for yields are mixed, and also heterogeneities for currencies and sectors remain. So policymakers should increase the attractiveness of green bonds in the present, and green bonds can to some extent already reflect better wealth accumulation in the present, but can also be improved in the long run by internalizing more of the externalities that we see. And thank you very much for your attention. And if you want to read further into this, we recently just released a report with the World Bank called Fiscal Policies for Low Carbon Economy. So part of our work is also reflected there. Thank you very much.
Okay, thank you. And the final paper in the session is entitled Climate Change Mitigation, How Efficient is Green Quantitative Easing? And this is being presented by Carolyn Nerlich.
Yes, hello. So I'm trying to share my screen.
Yeah, that's working.
Can you see it?
Yes, yeah,
Okay,
that's fine.
So, yeah, thank you. So I'm presenting the paper Climate Change Mitigation, How Effective is Green Quantitative Easing? This is joint work with Raphael Abiri, Marine Ferdinand-Dusse, and Alexander Ludwig. And just to mention the disclaimer, so these are the views of the authors and not those of the European Central Bank. So, oops, sorry. There is almost uniform consensus that there is a need for climate change mitigation, and there is also broad agreement that a carbon tax is one of the most effective instruments to achieve this. More recently, there was a discussion about the role of central banks in this respect, and that brought us to our project to think about comparing green quantitative easing to a carbon tax. So not to have a normative approach, what should be the optimal carbon tax and the optimal green quantitative easing, but starting from what is currently in the discussion and comparing these two, how effective are these instruments? And we assess this by looking at the emission reduction and the change in the temperature. Green quantitative easing in our model is understood as a shift in central bank private sector security portfolios towards green assets. and we take the stock of or the portfolio is given, and it's growing with the economy. So we abstract from trying to model the rationale for quantitative easing, because this is beyond the question we are interested in. So on our approach, I mean the way forward for our paper is that we have an integrated assessment model which is calibrated to the world economy. It's a general equilibrium model with two production sectors, the green or clean. I mean, we use these terms interdependently, and on the one side, and dirty and or brown on the other hand. Then we have a portfolio choice for households, so they can invest either in green, in clean and dirty capital. We assume that there is an idiosyncratic return risk for these assets. There is a zero correlation, and this is a very important assumption, because this then allows us to have a partial crowding out of green quantitative easing. We have a dirty energy sector which emits CO2, and I mean, all this is then captured in the climate model with a damage function, which has then an impact on the output. We have three policy experiments. So first, we look at the baseline and compare that to first when introducing a carbon tax. Then we look at the impact on when introducing green quantitative easing, and finally we combine the carbon tax and green quantitative easing in order to address the question whether these two instruments are supplements or complements. Just a bit further insights on how we model our policy instruments. So we assume that a maximum amount of green quantitative easing. So we looking at the data that we found, we took the largest size of a central bank's portfolios towards the corporate sector. And we assume that this is growing with the economy. And we also assume that there's a perfect taxonomy between green and brown assets. And when implementing this policy, we assume that there is a full and immediate shift by the central bank from their brown assets towards green. And we also assume a high elasticity of substitution between green and brown goods, and as I mentioned before, zero correlation of the asset returns. So this is with respect to green quantitative easing. With respect to the carbon tax, we assume a very low carbon tax in order to have a fair comparison. And we do not assume an increase in the tax rate itself. So it's just, I mean, relative to the dirty energy projection costs, it stays basically constant. Our results, in a nutshell, so green quantitative easing has climate change mitigation effects. But we find that these are less effective than a carbon tax. And our third result is that green quantitative easing can be seen as being complementary to a carbon tax. And maybe skip this in the interest of time. I mean, the literature we are mostly drawing on is are two papers by Kodlikov, and we also benefited a lot of the climate model by Golosov et al. But let me briefly introduce the the model structure, which is important to understand in our results. So we have first a dirty energy production sector and a clean energy production sector, and the energy production sector is then feeding or is used for the production of clean intermediate goods. So we have a clean and a dirty, and so the clean energy production or the clean intermediate goods sector is using clean energy, and the dirty intermediate goods sector is only using dirty energy. And then we assume that there is an increase in productivity in the green energy production sector, and that in order to produce clean intermediate goods, and we also the clean energy production sector is also using labor. So here we have the household sector. They provide labor to all four sectors, whereas capital is only, so I mean households can invest in capital only for the dirty intermediate sector and the clean intermediate sector. And these two sectors together then feed into the final goods sector. Then speaking about emissions, so they are only coming from the dirty energy production, and then we have a damage function, and which has a negative impact then on output. Finally, our policy institutions. So first we have the monetary authority. They have a portfolio of capital from the dirty intermediate sector and the clean intermediate sector, and as mentioned before, there can be a shift from the dirty to the clean. We also have a fiscal authority, and they can levy a tax on the dirty energy production, and the revenues are then sent back to the household in form of subsidies. So this is in a nutshell our model. And then we just for your background information, so we calibrate the baseline steady state, and we look at the transition profiles of the baseline scenario for the period 2015 to 2100. I mean, overall the model has 500 periods, but we only show until 2100. We assume that the central banks in the initial phase, that the central bank's capital is proportional to the size of the clean and dirty intermediate sector and the use of the capital in these two sectors, and that there is no carbon tax at the beginning. And then we have our three policy scenarios, which are introduced then in 2021. And we compare this, I mean, the baseline with the three policy scenarios. We calibrate the climate model by using data on CO2 emissions from the year 2000, and also we use the carbon stock data for the year 2000. For the price in the clean and dirty energy, I mean, we use we benefit from a paper by Hampel, Kraft, and van der Bloch. Then, as mentioned before, we use, I mean, we benefit from the climate model from Golosov and I. So now, important driving forces for our model are first, I mean, we have an exogenous labor supply. Here we use the data from the United Nations. And then I already mentioned before that we have this assumption that in the clean energy production, efficiency is gradually increasing. So then total TFP growth is less convex than what we experience for the clean energy production. And we have in the baseline, we have a constant increase in the carbon stock as a result of the model. So in the baseline also we have this emission in CO2, which are peaking around 2070, and then gradually the curve is then flattening, which has to do with this productivity increase in the clean energy sector. And we also find an increase in the temperature compared to pre-industrial times. Here, just a brief overview on what is happening for the energy prices. So we have a gradual decline in clean energy prices, whereas dirty energy prices are increasing, and that is explained by the different assumptions for productivity, and this explains then also why the energy input is different, because there is a substitution from the dirty intermediate to the green intermediate sector, and we have then also, and this has also implications for the other input factors, capital and labor. So let me move on to our policy exercise or scenarios. So here is the carbon tax, which is introduced in the year 2021, and then is growing with the economy. And here we have the quantitative easing. So the central bank has a portfolio where the share of dirty capital is higher at the beginning than the share of clean. And with the green quantitative easing policy implemented, there is a complete reversal and a depletion of a full depletion of dirty capital. So on the mechanism of these two policies, there are some differences. So for the carbon tax, we have, due to the carbon tax, an increase in the dirty energy price. So this has an impact in the intermediate sector. So there's a shift away from dirty energy, because the price of dirty energy is increasing. So this is a supply side effect, because then other input factors are used instead, and for the final production there's a shift away from dirty intermediate good due to the increase in prices for dirty intermediate goods, and so both effects point in a decline in dirty energy. The effect on with respect to green quantitative easing is more ambiguous, because the two mechanisms at play point in the different directions. Increase leads in the intermediate production sector to a shift towards dirty energy, whereas in the final production sector there's a shift away from dirty intermediate goods, and here this shift, the first effect here has to do that because the cost of capital is increasing for the production of dirty intermediate goods, then instead of capital, the firms use more energy and labor. And but this is counterbalanced by the second effect, and the net effect is that there is a decline in dirty energy. And this is what is shown in these two charts. So the reduction in dirty energy relative to the baseline is, so the baseline is the blue line here, and the impact with the carbon tax is that there is a strong reduction or a much stronger reduction compared to what can be achieved with quantitative easing. And similar results are when you look at the reduction in temperature relative to the baseline. So again, here's the baseline. And you see here in red, the line is the impact or the effect of a carbon tax, and the yellow is the impact of quantitative easing. So one important element also with respect to, or aspect with respect to quantitative easing is what is happening with the holdings or asset holdings in the private sector, whether there's full or imperfect crowding out. And so we assume an imperfect correlation between clean and dirty capital. So therefore, we find that, I mean, there is only imperfect crowding out of the quantitative easing. So you can see that here, the dashed lines are what the central bank is doing. So the blue dashed line is the increase in the holdings of green assets, and which is increasing, and the central bank at the same time then is decreasing its holding of brown assets. And due to the increase in the cost of dirty capital, the households start buying dirty assets, but not by the same amount as the central bank is selling them. So in net terms, there is still an impact on the economy. So it's only imperfect crowding out.
2 minutes, Karen, thanks.
Yes. I'm almost there. So just here we have our last exercise where we compare the results also when we have both policies at the same time. So here we show in on the left-hand side, you see the temperature increase in the baseline compared to what is happening if we have quantitative easing, which is so the temperature increase is somewhat lower. With the carbon tax, it's even lower and slightly lower if you combine the two instruments. So which supports the view that these two instruments are complements and not substitutes. But the addition, I mean, there are no positive interaction effects, and this is if you compare the baseline to quantitative easing compared to a situation where you have both and you subtract the impact of taxes. So these two lines are almost identical. So and that brings me to my final slide, where I just summarize that, I mean, the effect of a carbon tax on CO2 emissions is positive, or I mean, it leads to a decline in CO2 emissions through all the channels, whereas for green quantitative easing, I mean, there are ambiguous effects, and even if the net effect is positive or is contributing to a decline in CO2 emissions, the total impact is lower compared to what can be achieved with a carbon tax. So that was it from my side. Thank you very much.
Thank you very much, and thank you to all the speakers indeed for very much keeping on time. Okay, so we now have a discussant. It's David Carlin. So David, do you want to, I think you've around 15 minutes. Thank you.
Great, yeah. Thanks, Karen. So thank you so much for having me here, and really glad to be able to hear some terrific presentations and some thoughtful work. In my role as discussant, I am going to just cover a few reflections that I had on each of the papers, and hopefully get the conversation going amongst the group as well. So just about me before I jump into the content, I am David Carlin. I lead climate risk and TCFD programming for UNEP-FI, which is the UN Environment Programme's Finance Initiative. We've worked quite closely on understanding how financial institutions can play a positive and effective role in the work that goes on, both around managing risk and around decarbonization. And so both what are the impacts of disclosure, what are the impacts of other policies, and in forecasting those policies, how do institutions take the steps to be on the right side of a sustainable new economy? So just with that background, I would say a few things. I think that this is an important issue, but I would almost begin at the end with what Carolyn mentioned about the carbon tax, which is reminds me of a conversation that I had on I guess a couple weeks ago, and this was involving a few members of different regulators, as well as Bob Litterman, who had written the CFTC report, or had been the chair of the CFTC report in the US on climate financial risks. And the thing that we kept coming to is the carbon tax is, or the carbon price perhaps more appropriately, is really the key mechanism, the one that can drive and change incentives. And it has a effect because it is so near the source of changing so many things that directly relate to what you've mentioned, whether it's the companies that are issuing green bonds, whether it's the overall demand in the market, whether it's even potentially affecting the volatility and value of fossil assets. All of these are things that flow from the carbon tax. So I think we do, though, live in a not an optimal economic world, and rather a real world with real political considerations. And I think there's recognition, as mentioned in that last paper, that policies may not be implemented at the same stringency, at the same level. And while in a lot of ways climate is a collective action problem, we have to reckon with the fact that collective action, even when agreed upon, may not always be forthcoming. I think the Paris agreements were a landmark move in that direction of getting everyone on the same path. And I think this year at COP, we're very hopeful to see net zero come into focus as a commitment on the part of governments and countries. And so I absolutely recognize that while we talk about wanting all of these collective actions, how they actually proceed is different. And are there other mechanisms in the economy, both through public and private sector, that can play a significant role? And then kind of to that point, getting to the second paper and hearing specifically about the role of green bonds. And I think that this has been all the rage really the last couple of years. But the points I would make on that, which I think are really related to what we saw, is in looking at a lot of this information about volatility, I think it's very clear and very well proven from the analysis that fossil assets are likely to be exposed to volatility, likely to be exposed to declines in value, and that in many ways green assets are preferable to them and can play a positive role in the solution, whether those are being bought by private investors or by the government, in order to really align, as Paris says, align financial flows with our climate goals. So I think that there's a lot of truth there, but what I would also note is we are talking about unprecedented shifts. And so questions of volatility and questions of value, I think, are ones that we also want to be very forward-looking in our regards. When you pour a ton of money into an area, how does that change the potential for bubbles and volatility? Also, going back last week to a report in The Economist about raw materials, we are absolutely at the start of the transition. There's no question, I think, to any observer that climate action is underway. Is it proceeding fast enough? Is it aggressive enough? No, not yet. But we have started doing something different. Is that being borne out in emissions? Again, not quite yet, but in the growth of renewables, of the rate of investment in renewables relative to fossil assets, in the installed capacity, in the prices, there is a change afoot. It's clear. The question, though, is as that change reaches 20% of energy supply from solar and wind, 40%, 60%, as electrification becomes the predominant way of powering passenger and road-based vehicles, I think that we get into big questions around demand. We get into big questions around company behavior, and also just even the supply side resources. And so I think that a lot of this analysis is really, really good and well taken. I would just say it's also important and interesting to think about what happens when these aren't sort of the scrappy newcomers and underdogs, but rather the big players producing significant portions of a country's energy or otherwise, and what does a sort of saturated green market look like in a way that avoids bubbles. And so from that standpoint, I think looking at what the future holds and what kind of policies can smooth and accelerate the path. I think this is the real challenge to decarbonization and sustainability. Is I think very often people confuse this idea of what is called the temperature target with the challenge of the scenario, with the degree of transition risk. And I think that that's not quite right. I think that there are many pathways to the same temperature outcome. We talked a bit about that, and last week with the NGFS's new scenarios, we see differences in pathways between, say, a divergent net zero, the uncoordinated response, and a smooth net zero. And so our goal is to minimize economic disruption and accelerate climate action. And those two are not by any means oppositional, but they also are not inherently linked. There are ways to do one that compromises the other and vice versa. And so just to that point, I think it becomes particularly necessary and important to think about what are the policies, what are the stabilizers that governments can undertake. Getting to our last speaker, what are the other steps that, even if perhaps less effective than a carbon price, can smooth and accelerate some of these things? And so we looked at that green QE and that last paper as an example of that, and recognizing with any big government investment, you do have some crowding out effect, but given the empirical data, it's clear that that is not going to crowd out private investment to an extent that either negates or causes a significant compromising in the effectiveness. Now, getting onto the first paper, and apologies because I've sort of gone in reverse order. I think that this connection between sovereign risk and climate is an important one. And what I liked about this a lot was this is a nebulous space of climate forecasting, and especially economic forecasting on climate. And it's really, really tough. And I think picking one key indicator, one key factor that you want to look at is a good way to do it, because very often when we work with models, people always ask me, oh, what's the best model? What's the best scenario to use? And that's not really a good question. I think everyone here very much understands that that's not a good question. But the point is that you do have layered and interrelated complexity. And I think that that has come to the fore in the production of, say, ESG scores and others. And so looking at what can we really strip down and tease out at a sovereign level, I think is super important. I'd be interested also to think about kind of tying it to a couple of the other papers. What are the funding needs, and what protective roles do investments in resilient infrastructure, in adaptation, have on the ability of governments to better manage climate? And I think that's one of the questions, is not just for sovereigns, but also for any more local communities. It's not only the uncertainties of the physical effects, but also how they're dealt with. And I think in the real issue of climate justice, we have the recognition that those who may be most affected are the ones that are both least responsible and least able to cope with the challenges. And so understanding what sort of protective role adequate adaptation financing and resiliency can provide is, I think, important, and whether it covers all types of hazards or whether certain interventions are more effective for others. And then on the topic, though, of costs, I think this idea of almost paying a climate tax in one way or another, in this case of higher debt service and due to those interest rates, I think that's a really interesting way of thinking about it. The question then from a policy side, and it relates to the third paper a bit, and also to just the green bond market in general, is how do you begin to equate those things, and how do you put a value on both how big the size of the program should be, and how do you weigh those costs and benefits of what is the degree of investment necessary, both to keep costs down, but also to recognize that money will be spent or lost one way or another, whether it's due to climate inaction or climate action. So how big is does the government footprint need to be, and what role should government take? And maybe that gets a little more into sort of a different branch of economics, but all of that to say, I think some really interesting papers. The points, as I said, I wanted to draw attention to are really, what is the future of the green transition, and what is the role of the financial sector in that? What do governments do in the cases where global climate policy is not fully coherent or fully online at the same time? And finally, in terms of the damages faced, what sort of protective measures can be provided through adaptation and mitigation financing? So I'll leave the group with those thoughts. I hope that's helpful. I tried to stay away from being too technical, just because I think we've heard from some real experts, and I wanted to try to draw it into the realm of the institutions that I work with, but super eager to hear how the discussion goes. So thanks again for having me to speak and to discuss a few of these things. I think it's great work, and it needs to be done. Quantifying these things and understanding the mechanisms of action are going to be critical in the years ahead. So just again, commending the good work, and of course a big thank you for having me here at this EUROFRAME conference.
Thanks very much, David. Very nice overview of the papers and their contributions, and drawing out some very interesting issues. We've got just under around a quarter of an hour for general discussion, so hopefully I can manage this. If people would like to just general comments first, if anybody would like to pose a question to any of the speakers, I think it's just raise your hand there, is it? Or maybe I might see it in the chat function. So if anybody, I'm just keeping an eye here on all the, I think we've around 23 people attending. So if anybody would like to volunteer a question or a comment. Okay, Andreas, I see you have your hand up. Do you want to respond to some of the to the overview there, or is there a general point?
I have a question for Carolyn. I don't know if I got the number right, but I think combining green quantitative easing and carbon taxation, I think led to a decrease of about 0.9 or 1 gigaton of carbon, I think was one of the graphs. Maybe you can comment on that, because I thought that's actually, if based on the model, these policies are enacted, that seems like a very low number. If I think 0.9 gigatons carbon is about 3 gigatons of CO2. So that's like 10% of the global CO2 emissions. So if these numbers are right, it seems like a very low reduction for what's possible. So yeah, what are your thoughts on that?
Shall I respond?
Sure.
Or you want to collect further? comments?
I think at the moment, yeah, no, I think maybe if you'd like to respond to that one, and we'll see if other questions come in.
Okay, yeah, thank you, Andreas, for the question, and also to our discussion for the nice overview and summary of the main points. And related to your question, I mean, we calibrated the model on purpose such that it's kind of I mean, a very realistically very low carbon tax. So I mean, it's and on because given that the portfolio size of the central bank towards the corporate sector is also very small. I mean, we thought it's I mean, in order to be able to have a fair comparison, so both instruments are in this sense very low. I mean, we were thinking of extending maybe also to look at sovereign and debt, or even also allowing for introducing capital also in the energy sector, which would then even increase the portfolio size further. But I mean, that was a bit the rationale behind. So I mean, not to have a kind of optimal policy, but given the limited size of the portfolio of the central banks, where we found the data, then also to assume a very low carbon tax. So I mean, there we looked at, for example, something. I mean, what the IMF recommended at in one of its papers, and so of 50 US dollar per ton of CO2, which is pretty low given what is needed. But I mean, you're absolutely right. I mean, the results are disappointing. But I mean, if one would feed in numbers that are, I mean, given by Stern or other authors, then of course the impact would be much larger.
Thank you, Carolyn. Any other questions? People just like to raise their hand. Matthew, I think you have your hand raised there.
Yes, I've just raised it. Thank you very much to all the very exciting papers, and to David for the excellent discussion. One of the points that David raised was, you know, how will mitigation and particularly adaptation and resilience investments affect, for instance, the credit worthiness or the effect of climate change on ratings? The short answer is that in the real world today, it won't, because the way that S&P and Fitch and Moody's and indeed all of the others really calculate the sovereign rating is they ignore it. They ignore adaptation and resilience entirely. So what's the next step then? Well, it's for us as climate economists to go out and tell these guys they're doing it wrong. That, hey, we know there are real world climate risks. That's what the science tells us. We've done the economics to tell us what the impacts might be. We've shown how that might affect the rating using your current method. And now what we're telling you is you better update your method, because you created that model in the 20th century. And we're way beyond that now. So let's start getting the ratings agencies, let's start getting the Network for Greening the Financial System and UNEP-FI to start talking about how we can measure investments in adaptation and their efficacy and incorporate that into risk projections.
Great, thank you very much, Matthew. Any of the other speakers like to comment, or?
Yeah, thank you. Actually, I have a question to Matthew. First, I would like to thank you all for your presentations. I'm particularly interested in this QB discussion, Carol, and I would love to talk with you later. And thank you for David's comments. Some of these topics that he mentioned, I think that somehow are also discussed in the World Bank report we have just released. So I invite you all to read and send your comments, please. But on top of this, I have a question to Matthew, actually, regarding how he deals with the sovereign risk for developing countries, the sovereign climate risks for developing countries. Why am I saying this? I'm from the developed country, I'm from Brazil, and we know that and the S&P rating is much associated with commodity prices. And we know that all these commodities are at risk. Some of these commodities are at risks due to climate transition and industrial structure. So my question is, it was not so clear if actually your methodology deals with industrial structure, transformation due to climate change, and how do you think it would change, should change the S&P and other agents' ratings, sovereign ratings?
Yeah, it's a great question. If we recall that map, the green map that I had, which was just my attempt to try to convince you that our ratings prediction model was okay, where I showed you how many notches off we were from the current ratings that already exist. Brazil is actually one of the countries that we predict the best. We have an exact match. So we're not off by even one notch on the 20-point scale. But you're right that in the future, there will be other components that go into the rating that we've not captured. We've got a pretty parsimonious model. Only 6 variables are included. We don't have anything for the social situation in the country. We don't have anything for the political situation in the country. I desperately want to be able to include these. If anybody can find me even an okay-ish assessment of how political stability, how social stability, how monetary data, so your sort of monetary position, your monetary policy position, are going to change as a result of climate, let me know and I'll throw it in the model. It'll be my top priority. We don't capture structural change. Specifically, to answer your direct question, we don't capture structural change. What we do capture is, under each climate scenario, how much we expect GDP to fall. Because we don't factor in the structural change, I would consider our models to be, or our results to be underestimates. We're not factoring in the transition risk. We're not factoring in climate refugees. We're not factoring in climate wars. So our results should be considered pretty gross underestimates.
Okay, thank you very much for that. Just looking down, I don't think there's any other questions. If anybody, or maybe just one last call, if anybody else has one remaining question, we may just have enough time. If not, maybe we can, I'm just giving an eye here now. Okay, so maybe at that we'll conclude the session, and thank you very much to all the speakers and to the respondent, the discussant. It was very, very informative from my perspective, and I think some really, really interesting issues arose out of it, and I'm sure we'll be addressing these in the months and years to come. So thank you very much, everybody.